Hi, Ron. It's Stuart here again. Welcome to the first of a series of 4 webinars we're doing this time on a Friday. So it's today, the first. Can't see me, apparently. That's not great. I can see myself, Katerina. Hang on a second. Why isn't the web? Can't see the stream. It's live on. Okay. Right. Okay. We are okay. My picture's gone. My camera's go ahead. Continue. Okay. Right. I'm not sure if my screen's gone now. Hopefully that's good now. If you can't see me, guys, there might be only because we're streaming on multiple platforms. I might have to switch my good-looking face off. So let's just make me a wee bit bigger. Those of you who don't know me, my name's Stuart. I've been around longer than I care to remember trading markets, but more about me in a minute. I'm sure I'll be as quick as I can. So we can see the screen. Very good. Thank you. Thank you, boss. Right. So advanced risk and money management, the two of the 3 most fundamental things to keep you trading successfully. The money management, many argue, it's simple numbers. That's all it is. Simple numbers. Don't overcomplicate it. Risk management is the same thing. It's simple numbers. Don't overcomplicate it. Keep within those parameters. You stay in business. That's the most important thing especially if you're a new trader. Even as a more advanced, experienced trader, it's all about not losing too much and staying alive to fight another trade. It's all about the accumulation of thousands of trades, hundreds, thousands of trades, whatever it is, of your trading lifetime, not just the last 3 or 4 winning trades or 3 or 4 losing trades. Don't focus down on that. So anyway, let's go. I've got an hour. I tend to talk too much, so apologies for that. So good evening, good morning, good afternoon, wherever you are in the world. Welcome and thank you for your time this afternoon. I really, really do appreciate it. Any questions, please stick it in the chat box, whether you're on YouTube, X, or the Discord group, and the guys will send them to me, and I'll do my best to answer best I can. If I can't live, we'll do it. We'll send you an email and update things that way around. So let's crack on because there's a lot to get through. Most of it's straightforward. That's what I like about trading. That's why I'm quite good at trading, because I'm a simple soul. If it's going up, buy it. If it's going down, sell it. It sounds easy. It's not easy, but keep it simple. It should be simple. So let's go, see if my slides are working. Right, so those of you who don't know me, my background is principally in the City of London. I work for 2 big banks in the City of London, the Royal Bank of Scotland and UBS, for case of name dropping, for the best part of 20 years. I then took quite a life-changing decision. My wife and I just turned 40 the year before. My brother-in-law and sister-in-law had moved to Cyprus. He was a English Cypriot guy. Had been promised a job. So anyway, a few years after they'd gone, we picked the family up and took us to Europe, to Cyprus, and we lived and worked there for well over 20. We lived there for 20 years as well, and I worked for brokers in Cyprus for a best part of 12 years as well. So my mantra about trading and investing has always been the same, right from the very, very early days. It's always about keep probability on your side, keep it simple, and trade the time frame that fits your lifestyle, fits your personality. Always do what's probable and keep it simple. It's all in the numbers. But fundamentally, we're going to talk more about this next week. It's also all about understanding yourself. So if you're trying to be a scalper and you're not psychologically or physiologically designed to be sort of trading those very short time frames, you're never going to get off first base. Consequently, if you're trying to do a swing trade and only look at charts once or twice a day, if you need a bit more action, swing trading, pivot turning, waiting, patience isn't going to, over a long time period, isn't going to work for you either. So find something that works for you. There's lots of ways to make money in this business. Obviously, lots of ways to lose money as well. Unfortunately, most people do the latter, unfortunately, but hopefully if we apply some of the messages from today, it'll keep you in business, because that's what we want. That's what we all want, don't we? Let's see. Oh, there we go. So we're going to look at risk and money management. Trading psychology we'll talk about more next week. I've got my dirty dozen I talk about in most of my webinars. We'll talk about that next week. So staying afloat on the trading ocean is what we're going to look at today. We'll look at some probability, some percentages. We're going to look at some actual numbers of money management, how to apply it, how not to apply it. I'll tell you what I think about martingale strategies and everything else there and in between. Lots of books as well. I've got lots of books here we can talk about. One of the best trading books ever, but again, more on that tomorrow. Not tomorrow, next week. The Trading Game, a new book I've got. Well, same new book as last year, but there's another one called The Trading Game, which is all about money management. So this is a great book as well. Gary Stevenson, the best trader Citibank ever had, according to him. The Financial Times didn't think he was the best trader he ever had, but he got out of the city. But more on that, as I say, next week. Yeah, it's all about you, this business, my friends, and understanding yourself. So 3 criteria for me we should always focus on. You've got to understand yourself. I'll say more on that next week about beliefs, so we'll skip through these first slides quite quickly. What we've got to focus on today is risk and money management. So vital for success, understanding the components of both risk management and money management and why they're different. We're doing this in 2 sections today, so second bit's all about money management. So as I've touched on already, do what's probable, keep it simple. It's all in the numbers, especially thinking in percentages and not in dollar terms. That's another big mind game we get focused on. We focus on trying to win money or make dollars, $1,000. Think in percentages. It takes the bit of the psychological pressure away from you. So I'm going to skip through these quite quickly. So knowing yourself, it's all about time frames and timing. So when do you want to trade? How can you trade? How can you fit it into your lifestyle? Make your trading fit around your lifestyle, not the other way around. If you want to be a full-time trader, that's all well and good, but have at least 6 months, 12 months worth of money sat there in the bank that you're never going to touch so you can live on that. Don't try and trade money to make money every single month or every single week or every single day. It puts far too much pressure on you, both physically and psychologically and physiologically. It's very, very difficult, guys. So be careful trying to do that. Try and fit it around your lifestyle, whether you're a student, whether you're retired, whether you're working, whether you're not working. Fit trading around yourself. Again, more on this next week. It's a mind game. It's an emotions, fear, greed, hope, and regret. We get rid of hope and regret. We can't have hope and regret when we're trading. Get rid of hope. Fear and greed, we manage them more. I say more next week when we talk about the psychology of trading. They're the same coin, just either side. Fear and greed. I say more on that next week. For me, longer time frames makes less emotion, makes better decisions. That's why I tend to trade with my real money, my real account. My self-invested pension fund. It's all on end of day trades. But yeah, so point of today, risk management, vital for success. I would argue anybody into the ground. The old acronyms, the old cliches, they're all true. Scared money never wins. So don't borrow money off somebody to try and invest, saying you pay them back because you'll be a successful trader. If you're going to lose, accept it gracefully. You will lose. You will lose when you trade. You will have lots of losing trades. Lots and lots of losing trades. I have them all the time. Post them every night up on our Discord group. Follow me there. These are real. I'm not making any of this up, guys. I did post it early on in the evening. We find out what's happened the next day or the next couple of days. It's that sort of trade. So we get hit. We all lose. How do you deal with losing? That's a mind game as well. So don't trade with money you can't afford to lose, and don't go and stick it on your credit card or borrow it from your family or your friends. It puts far too much pressure on you. I mean, do that, but just be aware of the pressure it'll put on you. PDC, I call it, patience, discipline, control. All those good things, and that's what we're going to talk about today in this risk management section. We're going to talk about all the soft skills. We're not going to talk about technical analysis. We're not going to talk about position, how to manage position size professionally. Great question. Keep it small. When you have a losing streak or it's not going well, keep it down. What's your strategy, Marks, to trade and follow risk management? Well, this is my mantra, my friends. Just bear with me for a little while, because success in trading is a mind game, and by keeping your mind balanced, you risk something that you're comfortable with. So if you're lying in bed at night, having got a trade that's open, let's say you're a swing trader, 4-hour end of day trader. If you're lying in bed at night worrying what the market is doing because you've got an open trade, you've probably got too much risk. It's all about risk management. So you keep it small. What can you afford to lose? The great traders, and I'm not a great trader, but I know every single trade I put on, I know exactly how much I'm going to lose if my stop loss gets hit. And that helps me sleep at night, or in the afternoon when I go and walk the dogs or go and play with my grandson. I know, let me say that again slowly. I know every time I get a trade wrong, how much money I'm going to lose. I don't think of the money, I think of the percentage. I'm going to lose 1%, and I'll show you these data in a minute. Okay, as it says at the bottom of that slide there, and I learned this very, very early on from that guy there, Larry Hite, the 1% rule. And one of his great quotes is, I don't trade for excitement, I trade to win. And by doing that, he knows every time he trades, he's going to lose 1%, 2%, 3% maximum. You know, some people, you know, and that's why most people blow their account, because they'll be risking 5 or 6%. You do that 3 or 4 times, your account's empty. It's as simple as that. You know, risk more than 5% per trade, or even 3% per trade, and you very, very quickly run out of money. Does anybody know out there what has anybody heard of the Monte Carlo fallacy? Anybody heard of the Monte Carlo fallacy? Monte Carlo, very, very famous casino in obviously Monte Carlo in southern France. The longest red and black, people were betting on red and black. It was 1913. The longest running streak of continual balls falling in the black. I can't remember if it's black or red now off the top of my head. But anyway, it was like 28 times it consistently fell in the black, in the black, in the black. People were betting on the red. Oh, it's got to fall in. It's got to go to red. It's got to go to red next time. It's got to go to red next time. You can have long, long running losing streaks. So if you're losing 4 or 5 trades in a row and you've risked 10% of your account, bingo, your account's empty, isn't it? Now, what tends to happen is that the people that do that will lose 3 trades in a row, having risked 5%. And then on the 4th one, I think, oh God, I've got to win this time. I'll put 10% on and then blow it even more quickly. Keep your risk small. We'll come on to that in a minute, okay? It's absolutely vital, guys, and just understand what you do. So every time I put a trade on, I know if that's my stop loss, say that I got in there and I was going long, if that's my stop loss, I know that that is 1 or a bit % of my total entire account. So if I've got 8 trades open, I know I'm only going to lose 10% overall. Is it okay having losing streaks while following your trading plan? Absolutely. Sorry, that came and went very quickly. Just find that. Let's have a look. Let me just find that here. My WhatsApp isn't going right. Question 3. Is it okay to have losing streaks while following your trading plan, and how to being comfortable with it? Is trying to switch strategy? No, my friend. Number 3. Question number 3. No. Well, that's one. We'll talk about this more next week, but that's another thing that lots of people do. I did it myself. My dirty dozen I talked about at the beginning of things we all do wrong as traders, and there's probably more than 12. I could easily write 20 or 30 things not to do that I have done and got wrong and lost money through. The older you get, the more sanguine you get about it. Obviously, when you're young, you think everything's got it. You've got to win everything all the time. So again, sorry about talking about next week. We'll talk more about that next week. So don't chop and change. If you've got a strategy, you've back tested it, and it works quite well on the 15-minute time frame, or the 1-hour time frame, or the daily time frame. Don't try and apply it to the 1-minute time frame, or every pip, or every 1 minute. I mean, some strategies do, and mine does work quite well across all time frames. But if it doesn't fit, as I say, if it doesn't fit with your mindset, that's where the problem is. But you will get long-running streaks of wins where you think you're the top of the world. You cannot fail, and you'll also get long running streaks of losing trades where you think you're the worst trader in the world and everything's wrong. We always remember the extreme. So we always remember our big trades, our big winning trades, and we always remember our negative losing trades. I've got a thing about, still to this day, I've got a thing about pound CAD, because I once had 6 or 7 consecutive losing trades in pound CAD over I think 3, 4, 5 months it was. Every time pound CAD came up, I lost. Every time it came. So as that streak went on, you know, I trusted my system. My system was winning overall, and that's what you got to look at. The end of the week, the end of the month, it was always we were always in the money. But every time, the next time pound CAD came up, not pound CAD again. And even today, I do it, you know, here at on the Discord group. I think we've had a pound CAD trade recently. It's just one of those things that sticks with you. Anyway, I've only got an hour, and it's 2:15 already, or 1:45. So patience. Whatever time frame you're trading, you've got to have patience. Wait for your candles to complete. Wait for your levels to be actually confirmed, indicators, whatever strategy you're using. If you're using something like VWAP or you're just using price action, you know, wait for the thing to do what it's supposed to do. Stick to your plan. We are useless human beings, all of us, no matter where we are in the world, no matter how intelligent or non-intelligent we think we are. Patience and discipline are fundamental to being a good trader, getting to that consistency that you're looking for, and accepting, you know, I am going to have 9 losing trades in a row. How do I deal with that with my head? That's the key thing. So keep that emotion, fear and greed in control. Get rid of hope and desire. I'll say more on that next week. But anyway, let's look at the numbers about actual risk management itself. So we often concern ourselves, and particularly new traders, on making money. The professionals, we turn it around. We look at preserving what we got, capital preservation. You focus on keeping what you have. You've got to take some losses, and quite often some significant losses over a period of time, to win the ultimate battle, the ultimate war, I should say. Sorry, I just went too far forward. If you don't manage your capital, my friends, I don't like using this word, you are just gambling, you're risking, you're just throwing things away. And that's one of the key things about the proptrade.com. You know, the rules are there. You can't lose more than 10% of your starting capital once you've bought your challenges. You know, the number one reason why traders fail is a lack of understanding of what we're talking about today, or applying it. You know, it's easy to listen to an old bloke blabbering on about it on a Friday afternoon or a Friday evening before the nice weekend, and you forget about everything. You've got to apply it. The thing about leverage and margin and all that other things that allows you to trade these accounts, if you don't understand how negative it can be, it can wipe you out quite quickly. How can I systematically identify and prioritize potential risks to create a proactive mind? Oh, it's a very intelligent question. It's far too intelligent for me on a Friday afternoon. How can I systematically identify and prioritize potential risks to create a proactive mitigation plan, especially in choppy markets? Well, the thing about sideways markets or choppy markets is you know, whatever position you're taking, your risk management plan should make sure, as I said at the beginning, you're only losing 1 or 2% when the trade goes wrong. So lots of people focus on risk reward. We'll look at that a little later. It's not something I get too uptight about. You know, some of my stop losses can be relatively much bigger than what my target is, but I know my system hits my first targets quite regularly. So it's got a very good high hit rate. So the stop loss is just an initial position. It then gets moved up quite quickly once the first target's been hit, or, you know, depending on the type of market, it can be just that's the target route. The stop loss just gives me a feeling of comfort. Okay, so it's a matter of applying it, basically. So again, markets tend to go sideways, you know, 70% of the time, and trend 30% of the time. I'm a trend following trader, so I always have been. I like angles on charts. I like things going up or things going down. I don't care what it is. You can make money when things are direction. When they're directionless and they're going blah, 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 blah. I had a colleague who loved that. You know, you'd buy at the top of the channel, sell at the buy at the bottom of the channel, sell at the top of the channel. He'd do that all day long. intraday. That's not really my style, although I do that. You can see things sometimes that look quite clearly, you still get in. So it's all about that, my friend. It's a matter of whether you're trading choppy markets, sideways action on whatever time frame, or trending, again, whatever time frame. It's applying that rule and your trading plan and sticking to it. That's the key thing. So if you want to, let's say you want to trade 5-minute markets on the gold chart. So what is gold doing on the 1 hour and the 4 hour chart? Is it trending? Is it going up? Is it going down? Is it going sideways? That's the first thing you need to decide if you're a 5-minute trader, and then find the levels, the support and resistance levels, whether they're sort of a slope or whether they're horizontal. The horizontal support and resistance levels, they're the zones you want to be trading through. So I hope that's answered your question. If not, type it back in again and I'll try again. So this is the other thing that I find fascinating. Having looked at literally hundreds of thousands of trades over 30 odd years, people come into this business with a bizarre respect or lack of respect for money. I remember having a very, very, very clever doctor. He was head of in the Caribbean. He was head of right, number 5. Shall I keep my reward to risk reward? We'll come to risk reward in a minute. Let's just check this. Sorry, I'll come back to the story about the guy in the Caribbean in a minute. Shall I keep my risk to reward ratio consistent, or should I adjust it depending on how much I want to win? The crux of your question gives way to me that you're a new trader, my friend. How much I want to win. What did I just say a minute ago? I'm going to get my school teacher hat on now. Let's just go back a minute ago. I've lost it where it is. This one. Read that slide again, my friend. The guy that's just asked that question, or lady that's just asked that question. Shall I keep my risk reward ratio consistent, or should I adjust it depending on how much I want to win? You've got to focus on, keeping what you've got. So, for me, because I'm a trend following trader, I don't lock in a target particularly. Yes, I do, up on our group, I do say target levels. But once a trend is running, it's running. All you do is, move your stop loss up as you're moving it. So risk reward, don't get too uptight about it. Different assets. This is the other key thing as well that lots of people get confused with. Different assets have different volatility. So 10 pips trading euro dollar is very, very different to 10 pips trading pound Aussie or pound Kiwi. They move much more with much more volatility. Their average true range on a daily basis is much higher than the euro dollar or the euro Swiss. Euro Swiss sort of goes sideways. Euro pound tends to go very much sideways action. It will trend, but the distance it travels is much less. So risk reward, again, don't get too beat up on it. But if you have set a stop loss, which you should, and have set a target, which again you should, leave it. Let the market decide whether you're going to win or lose. The beauty of that is, if you're not risking too much, when and if your stop loss gets hit, it's not going to hit you psychologically. You're not going to get too beaten up when you've had, oh God, I've had another losing trade. And that's the people that don't respect their money and don't take it seriously. I started talking about this doctor in the Caribbean. He'd lost well over £1 million with us. And he was just simply using it as sort of fun money. He didn't take it serious. Amazing, a guy so intelligent, so well regarded in his profession. I mean, he couldn't really afford to obviously lose that amount of money, but he had a completely different mindset when he was attached to the market, and he didn't want to move forward. He obviously spent all his whole life learning. He wasn't a young guy, and he got to the top of his profession. He was extremely well respected in that part of the world. But when it came to trading, different mindset took over. So have a plan, have a strategy, take it serious, never trade impulsively. Get in and get out with automate it as much as you can. Trade with a stop loss. I know, again, I've seen, as I say, I've seen hundreds of thousands of individual trades, and so many of them don't have a stop loss. More will have a take profit, because that's what people are focusing on. They're focusing on the money they're making rather than the money they may lose. You know, you've got to accept you're losing trades, accept you will lose money, and you've got to constantly manage your emotions. More on that mantra, I say, next week. You know, risk management is actually the key element to success in trading. Whatever your strategy is, whether you're like a guy who was asking about the choppy markets, you've got to have strict money management with on your strategy. So when you're going to get in, when you're going to get out, and money management, risk management, absolutely vital to it. So the maths is quite simple. You know, when you and you know, once you start losing, it can become quite self-defeating and a very, very slippy slope. So once you've lost, you know, 20% of your account, you're down to 80%. You've got to win back 25% of what you've got left to get back to zero, haven't you? So once you've lost like half your money, half your 50 grand account is down to 25,000, you've got to double what you've got left to get yourself back just to zero. And again, that's the mind game, that's the psychology of things that sits and beats people, lets their emotions get ahead of them, they get risky, they get panicky, the heart rate starts racing, the palms start sweating. If you don't keep your losing position small, lose 1 or 2% on each trade every time you get something wrong, and you will stay in business much, much longer. And you risk the chance of actually making money, because most people don't. Okay, keep your losers small is the mantra. To take one thing away from today, it's that, you know, keep and understand what risk you're taking. So most successful traders know they get a lot of things wrong. So what do? They limit their losses. They accept they will lose, but know overall they will be profitable at the end of the month, or at the end of the quarter, or the end of the year, whatever it is. You know, I had a colleague once that was actually, it goes back to 2016, and the first in the rise of the Trump and the Brexit situation, where I had a guy, a colleague, who had a strategy that had been losing all year, right until the end of September. And Trump winning in November turned his whole year around. He wasn't planning it like that. It was just technically where he traded. So he'd actually lost not every single month into September, but he'd had some big losing months going into September, but then he turned it around in October and December to actually win. He ended up flat for the year, so he won back in that last quarter everything he'd lost, and a little bit more in September. So, you know, it's just keeping faith with the system that you've had, or tweaks you make to your system overall. Right, somebody talked about risk reward earlier. I haven't really talked about risk reward. Lots of strategies, lots of approaches. The textbooks tell you, you know, at least 2 to 1 or 3 to 1 or more, but it doesn't have to be that high. I don't run with that. But also the other flip side of that, they don't come along very long. You see the stories of, you know, this has had a risk reward of 1 to 7 or 1 to 8 or 1 to 10. That's all well and good, but how often do those types of setups come along, and how patient are you as a human being to wait for that system to come along? See, it's all about you. Always, always, always about you. So if you've got a risk management system that's looking for a 1 to 5 or a 1 to 7 or a 1 to 10 risk reward ratio, it may never trigger for a week or 2 weeks or 3 weeks. Are you still a trader in that case? Are you applying that? Can you apply that? If it fits with you and that's your way, that's what your way of trading, all well and good. You know, find something that works for you, because there's more than more than one way to skin a cat, as we say in English. Okay, so it's simple numbers. This isn't mine. You find this on the internet. But hopefully you can understand what's going on that slide. So across the top there, we've got a win ratio, win-loss ratio. So here we're winning 10% of our trades, losing 90%. All the way over here, it's 90% win rate and a 10% loss rate. Down here is our risk-reward ratio. So so for every dollar we're risking, we're winning $2. For every dollar we're risking, we're winning $3.50. So it's simple numbers. Okay, so let's say we have a $5,000 account. If you want to, starting equity is 50,000. Doesn't matter. The numbers just, the dots, the zeros are just bigger. That's all it is. And that's the other key thing, guys. If you can do this with a small account, if you only got $100, you can only buy like a $5,000 or $10,000 account in your challenges. If you can do this with a $5,000 or $10,000 account, you can do it with a $100,000 account, with a $200,000 account, because if you can do it, you can do it. And it doesn't matter where you are in the world. It doesn't matter, whether you've got a degree or you haven't got a degree, whether you left school at 16, whether you never went to school. It's all about human psyche, success in trading. It's got nothing to do with intelligence. Emotional intelligence, yes. Academic intelligence, no, absolutely not. Some simple maths, but we can all do these simple maths, can't we? So that's what we're talking about now. So if we had a $5,000 account, 3%, this is quite high. 3%, well, it's okay. I talked about 1% before. We'll look at 1% in a minute. That gives you $150 per trade. So if you are winning, say 1 to 2, so that was your risk-reward ratio. You don't have to actually have it set. And you're trading. How many pairs do you trade? I trade all the major forex pairs. I look at the two gold. I look at gold, silver less so. I used to do copper. Copper's a bit messy, but on a normal basis, about 50 assets get scanned in my strategy every night, and mostly it's forex. So it's the major against the dollar, and then all the other big currencies like the Swissy against all the others. So it's a cross that gives you the 28. And there's the two oils. Stock markets indexes, I like trading indexes. The DAX is my favorite of them all. The Dow certainly on a short-term basis. So the major three in the US, the FTSE in the UK, the DAX in Europe. Typically the Nikkei covers my Asia trades. Gold, obviously. Occasionally crypto. I have a separate crypto system, but I'm bullish and long Bitcoin at the moment. That's not a don't take that as any advice or anything, but it's technically it's looking pretty good over 92,000. I know there's lots of crypto fans out there. Gold's been on a phenomenal run. We've had a really good run on that. We had a fantastic run on the Kiwi as well a long time ago. So that's what I do. I'm an end of day trader. I'm a trend following guy. If it triggers, I take the trade. That's the other thing I've learned. You can't pick and choose. If you've got enough equity and you can manage your equity, you can take them all. Sometimes I have to, I try to keep, below 10 active trades open at any one time. But again, that's just because I've got a bit more experience. But there's different rules for that, and it's what works for you, how much equity you've got, how much risk you want open at any one point in time. But if you keep your risk per trade to this 1 or 2%, even this 3%, as you can see there on the screen, you stay in business, or you increase your chances of staying in business very, very significantly, regardless of the time frame you're trading. So anyway, so 60-40. The guy that actually put this slide together, he had a win rate of 3.5. His risk was 3.5 to 1, and he had a 60-40 win rate. So he turned $5,000 into $25,500. You can see the numbers. It's that simple. If you don't understand these numbers, ask me. I'll send you an email. But you've got to understand these sort of ratios. What is your risk-reward ratio, guys? What is your current risk per trade? If you don't know, go back and find out, because that's what this soft stuff is what keeps you in business. Let's do this slowly and simply, okay? Same account size. Let's go for the 1% rule that Larry Hite first taught me, or I first came across. So 1% of 5,000 is 50, correct? Yes. Let's say, everybody say nod? Yeah. So assume we do 2 trades a day. 2 trades a day is 10 a week, 520 trades a year. Yes, if we trade 52 weeks of the year. Yeah. Let's assume we win 6 out of 10 trades. Okay, it's better than flipping a coin, isn't it? Flipping a coin will give you 50. You should have some sort of edge. And there's a great that is true as well. Most people, winners, losers, trades wise, win about 55-54% of their trades. 90% of traders, 95% of traders lose money, because although they're winning 55% of their trades, they're losing trades, they're losing 45%. It tends to be at least 1.7 bigger than their winning trades. That's a fact from, and it's always been around about that sort of case. So that's what you're trying to break, guys, because the win rate, only winning 6 out of 10 isn't good enough for most people. It would just about, when I went to university, I would just about have got you a first class degree, 60, or was it 70? I think it was 70, wasn't it? Yeah. But these days, you see all this nonsense on the internet. I've got 80% hit rate. I've got 98% hit rate on my system. That's fine. That's great, mate. Are you making any money out of it? And the answer is usually no. Oh, no, I'm even. I'm not sure. Well, your strategy is not great then, is it? You're winning 98% of your trades, but you're still not making money. Poor risk-reward ratio. Anyway, and it's managing the 40% that you lose is the other thing that beats people up, because you don't get 6 winning trades and then 4 losing trades. They'll all be mixed up. You might get 6 winning trades all in a row. You might get 4 losing trades all in a row. You might get more than that. Dealing with it psychologically. So let's assume if we're going to risk 50, we want to win. Let's call it 1.5. So we're going to risk $50. We want to win 75 euros or whatever it is, dollars, euros, pounds, and whatever. It doesn't matter. Okay. So if that's our numbers, that's our stats. These are our numbers. Okay. So if we're winning 60% and we're keeping our risk low, we win 23,400 over the period of the 520 trades. That makes sense, because we're winning 60 of our 520 trades and we win 75. Our losing trades take away from that 10,400. So overall, we've won 13,000. So divided by a month, we're up over 1,000 per month, 20% per month, or 200 odd percent a year from our 5,000 starting salary account. Honestly, it's that simple. If you don't know these numbers for your account, go and do it now. Promise yourself you're going to do that this weekend. If you don't know these, you don't need to worry about Sharpe ratios and all that sort of stuff. We can talk about that another time if you want to. Kelly ratios, but understand these basics first, okay? And that last line is the other one that should really hit home as well. Even if you're only as good as a flip of a coin, i.e. you win 50 and you lose 50, and you're not winning 75, you're only going to win 60, you're still making 4% a month. It's better than interest rates, isn't it? Trading is for everyone. Everyone should give it a go. If you're a female out there, you are physiologically and psychologically better designed to be a successful trader than us men are. Again, more on that next week. Okay, guys, what time is it? It's a run over. I talk so much. I'm so sorry. Oh, no, it's only half an hour. Yeah, I've got 20 minutes left. Right, let's get on to money management and risk management. So stick to the 1% rule. Here are some live examples of it. Okay, so risk per trade, profit per trade, number of trades. You see what I'm saying here. Obviously, with proptrade.com, you can't lose 10%. You can't risk 10%. A trade won't let you. We're looking at, keep it 3%. But the point I'm making here is that, even the guy that had a really good hit rate, 90%, he would have been risking too much because his profit per trade was poor. So he's still going bust, So stick to these 1%, 2% levels. Even if you're only winning 50, 60% of your trades, 55% of your trades, you still make money, you're still positive. Okay. When I put this slide together a few years ago, this black column here was my performance. This is what I was doing a few years ago, and I was trading more actively. So, the problem is lots of traders are way, way above this 1 or 2%, even 3%. 5%, it's sort of acceptable, but you're still quite risky, because if you lose 5% on each trade, again, it very quickly has a big hit on your account. 1% keeps you alive. Doesn't mean you're going to be successful. Doesn't mean you're going to make money. What I'm saying is, it increases your chances of staying in the game hugely, and therefore it gives you more experience with real money in real markets with real data feeds to get to those funded traded accounts, which is what we're all about, aren't we? So keep it simple. If you want, this is a very, very simple Excel spreadsheet, as you can see by my my little chart. If you want a copy of this, please let me know. RamFX, thank you very much. It's just, it's experience, Ram, more than anything. It's just, and the older I get, the more significant this soft stuff becomes. When I first started, it was all about the charts and the angles and my, patterns and pattern recognition and winning. It was only when I realized that you're going to lose a lot here, Stewie. And again, I'll talk more about this next week, but my psychology, I'm a bit of a know-it-all. That's just the way I am. It's horrible. Drives my wife mad. I'm a bit of a told you so. I'm one of those horrible characters as well. And I talk too much. So traits that are really, really bad to be a good risk manager and a good money manager. But I've learned that. I've dealt with it internally and externally. And therefore, the light bulb went off for me when I realized you will lose a lot. You're not going to be right all the time, Stewie. And that was my, golden moment, if you like, Ram. So thank you for that kind comment. But that's what we're here for. We're here to make your life easier and try and shortcut some of the mistakes I made and every other trader makes. And again, I keep talking about next week, but more on that next week as well. The dirty dozen from next week. So it's everything. Take what you have. Great risk management can make an average method successful. A poor and weak risk management system often and does ruin a successful system. Know when you get out before you get in. Bruce Kovner, another great legendary trader, one of the original. I thought I had his book here. I haven't. One of the original legendary market wizards. So I've got 20 minutes left to go through money management. This is the numbers game. It's all about the numbers, guys. You should be able to do this. I'm going to look at 3 very simple ways, and I'm going to tell you what I think about martingale as well in the next 20 minutes. So what is it? It's a numbers game, as I've talked about before. It's vital, and I say some call money management the most important component. It will tell you, it will determine, how much you make, stop a losing experience being a winning experience, but it'll also turn you into could be a fantastic returns, because there's no cap to this business. There's no ceiling on your earnings. It's not like, working 40 hours a week, 9 to 5 or 5 till 6, or, whatever it is, 8 till 8. You work when you want to work. You apply your knowledge 24 hours a day, because the markets are open 24 hours a day. For heaven's sake, Bitcoin, you can trade it over the weekend, can't you? So it's 7 days a week now. It's mad. But as long as you know the risks of trading, when the volatilities can be fairly high and the liquidity very low, I'll be it. But it's there to do it. But money management is key. It's all about having a system that allows you to compress. We talked about one of the questions earlier was talking about increasing and decreasing your position size. Your money management strategy should be able to give you this. Okay, there are good ways, bad ways for money management. It's all about risk and reward and the leverage on your account by balancing the risk. It's the key way of analyzing your account, your equity curve. It never goes up smooth. It's all peaks and troughs, but you want to iron out these big drawdowns, because that's what does you both monetary wise, financially, but more importantly, psychologically as well. They're the things that really drag you down. Our mind will focus more on our big losers than our big winners. And I said before, we focus on the extremes, but we tend to focus on our big extremes, but the losers tend to have a much more negative or much more impact on our brain negatively than our winning positions do and our winning trades do to the upside. So it's all about keeping the risk small, keeping the losses small. It keeps you in business. So martingale against anti-martingales. The idea of martingale is that you have a losing trade, and you just increase or double the position size in order to recoup the losses to make a little profit. It doesn't work in long term. I had a former colleague who would argue me to death that he had a system that had been running for 2 years. It was successful. He was making 20% Yeah, okay, 2 years. That is quite a good long time frame, and it was successful, and he proved it and showed me to it. But I don't know. I haven't seen him for over a year and a half, so whether it's still successful or not, I don't know. Martingale is very dangerous. Be careful getting suckered into it. I know some people will argue the toss with me. But the idea being that a losing streak doesn't go on forever, just like winning streaks don't go on forever, and eventually you will get back. But you're risking everything on one big winner at the end. Psychologically, it's all in very, very difficult to implement fully. They can create massive risk, geometric risk, parabolic risk, not growth. You're really going to risk blowing your account simply to make a little profit. Methods appear attractive, but they don't work. They're dangerous and can actually be catastrophic for your account. Everything we're going to talk about in these next 20 minutes or next 15 minutes is all about anti-martingale, normal, keeping the drawdown, controlling the risk, a smaller drawdown, and very much an anti-martingale, but it's not a martingale approach. Increase the position size as you win. So it's like pulling your stop loss up as you're winning, or pulling your stop loss down as you're winning, as the sell trades going on. So but again, guys, as I said, and I'm going to say next week, it's about you, as with everything in trading. And talk about, these are generic, it's not phrases. All of this stuff is nothing new. This has all been around for years. I've just pulled a lot of ideas that I applied for myself. So it's about getting returns for the risk on the place. The idea that you trade it like you see the guys on Bloomberg or CNBC or whatever business channel you watch or you don't watch, they're slow to burn. They're fund managers. They're paid to manage this fund to keep the risk small. They're great for that, but they don't, tend to go mad with that. But they will apply good money management and good risk management. Pension funds, they're long-term investments. They take minimized risks. Individual traders, we can increase our risk a little bit more, but not get too carried away. If you get confident and successful, you can start risking a bit more. I'm talking about 2 and 3% all the time, but obviously I've had positions where I've risked more because it's been going good. It's been winning, it's been a strong trend, and it's just the momentum's with it. So I increased the risk on those, having already made some money, having already bagged some money, having brought my stop loss up above the entry point. So I know I can't lose on this particular trade, but I know there's still, I don't know, but I feel like there's still some more legs in it. Okay, money management is not risk management. So the first part of the talk today, we talked about risk management. It's probability of positive return. Money management is not position sizing. The difference between entry and stop loss divided by money management gives you the size of your trade. Risk management, the amount of risk you're willing to take on each trade. Position sizes addresses the position you use for that trade. So ways of implementing money management. Money management will determine whether the size be increasing or decreasing. That's the key difference between the two things. Don't get them mixed up and confused, but do use them together as well. And then the third step, that psychology, that understanding yourself, we'll do next week. Okay. I hope that makes sense. You're not just because you're a bad trader, money management isn't going to turn you into a good trader. It's numbers. You've got to be able to follow it. It can't turn a bad strategy into a winning one. If you don't have the discipline to trade correctly, then money management's not going to work because it's just numbers. Okay. What it will do, though, it will open your eyes to potential geometric growth. Positive expectancy is what we're looking for. It will not help you make money, but it will rate it down. That's what we're doing. So there's 3 ways. It gives you path, rules, discipline. Get too aggressive, you can move things down, and make as much money as possible as an independent trader. Without blowing your account. Okay, we've talked about this already. Simple 2% rule, 1% rule, 3% rule. We've shown all examples. So the risk per trade is your account balance of time 2%. Keep it like that. It is quite a conservative approach, but it keeps you going. Theoretically, you'll never run out of money no matter how many times you lose. It's a good method if you've got a relatively good account. Large accounts don't need to risk as much to achieve acceptable returns in money terms. That's what I'm saying. The fund managers, the pension funds, they're kind of happy to stick with this. It is a relatively conservative approach, but anything over 3 or 4%, brokers start thinking you look like you're gambling a wee bit on things. So don't get too aggressive. but you can apply it in most markets. So that works for me. It's worked for me over the years. You know, get going with it to start off with, guys. That's the other thing. Get it, feel comfortable with it. It's balanced. Each trade has its own risk. Don't trade a fixed pip amount, because you know each asset has a different amount you can move, but you do fix the risk of losing to 2%. So whether you're trading gold expecting it to run $20 or euro expecting to run just 2 or 3 pips, if you lose, you're only going to lose a maximum of 2 or 3% of your account on each and every trade. Okay, next one is fixed fractional method. Okay, this is very popular in the futures market and contract basis. Next two, we're going to talk about contract basis. Okay, so it's a dollar amount we're looking at. So one fixed fractional method commonly used to trade contract for each X amount of dollars in the account. So it can be set for either X can be either big or small. Okay, dollar amount established which will be used to each and every trade. The number of units is determined by dividing the price of the asset that you're trading into the desired position size. Okay, so great example. We want to trade a $40,000 worth of position, whether it's FX or whatever it is. We divide the price we get, 148.57, into the amount we want to trade, so 40,000, giving us 26,923 units. So in time, we are ready to enter our next position. The price may have moved. It will have moved, won't it? So 149.38. We then divide the new number into 40,000. It gives us a lower entry of 26,780 units. When X is too large, this method is risk averse, but growth is slow. Makes sense. When X is too small, then growth is quick, but there is a possibility of catastrophic loss. If you lose consistently, i.e. you have 5, 9, 10, 12 losing trades in a row, you can run out of money very, very quickly. Okay, so it's not an ideal method. I'd prefer the more conservative. It's just my personal approach, but fixed fractional method, i.e. fixed X amount, fixed contracts and change the amount of dollars is another approach. It's, as I say, it's if you have a lot of losing trades, it's not great. Okay. The next one, I think personally, is the best, and you'll see lots of people talking about this. This is a fixed ratio money management method developed by Ryan Jones back in the late 90s in his book, The Trading Game. Remember I showed you the Trading Game book at the beginning? Well, Ryan Jones's book, called The Trading Game, came out in 1999 and talked about Delta as his approach to money management. Simple, but I mean, again, lots of things in trading, the simplicity of them surprises lots of people. It surprised me when I first came across it, but it's just like, oh yes, when the penny dropped. Okay, so what this approach did that Ryan came up with was focusing on profits made rather than the account size. So it works across all account sizes. So whether you got a million account, a 1,000 account, or a $10,000 account, 50,000, 100, it works across all account sizes because it's using something he calls delta. If delta, for in this example, if delta is $1,000, the position size increases when $1,000 per contract in profits are made. So it's all related to, so you risk more the more you've made. Doesn't that make sense? So the more you make, the more you risk, because you're applying, because you can do that. Okay, so delta is determined by the maximum drawdown of your trading plan. And if you don't know what that is, you can't apply this, can you? So you need to get some strategy, some trading under your belt. So if your strategy, like the martingale approach or some of the martingale approach, produces large drawdowns, you'd have to reduce your delta size. So instead of say, default, whatever it is, at least half, but it would still work, you know. So as long as you have enough capital in your account, you can cover risk, margin, and some breathing room. It doesn't matter whether you have 1,000 or 10,000 or 100,000 or a million in your account. It's not a factor. It's all about this thing, delta, where we're looking at prices per contract or prices per position. Okay, it's a great little, well, it's not a little book, it's quite a complicated book, but literally it changed things for many, many traders I know. So Playing by Numbers to Make Millions, The Trading Game by Ryan Jones. It came out in 1999, and it's probably the most sophisticated money management technique independent traders can approach. If you don't want to just use the simple, relative more conservative 2 or 3% per account size, this can move your account up exponentially very quickly. So I thoroughly recommend Jones's a delta approach to risk and money management. So there's different ways to skin a cat, guys, as I said at the beginning. But if you keep the risk and money management in check, or you understand money management, you apply risk management to your money management, you're disciplined, you're patient, you can become, a successful trader. Whoops, there we go. So the reason that the fixed ratio works on multiple account sizes is that you can sort of scale in and scale out of positions as well, because you're looking at how much money. Here we're talking about futures again, so per contract, or if you're trading on the TradeLocker platform per position. Okay, so you increase the position every 1,000 per contract, so you're going up in proportion. Okay, that's why it's pretty good for smaller accounts. If you're on futures, it peaks out or averages around about the 4 or 5 contracts. So that scaling in approach, I think those of you that watched the Heiken Ashi webinar I did, or talked about the scaling in approach of the Heiken Ashi candles, this is a great way of applying that. The first big candle with no wick, you open up with 2 contracts or 3, and then you add contracts as the candles change. So the bigger the account, the more effective this is, and it is used by many professional fund managers as well. The more fund accounts also run this fixed ratio method as well, and it can, as I say, it can give you that big, huge parabolic growth, geometric growth in your equity curve without the risk of martingale approaches. So really, in summary, it's as I sort of touched on at the beginning, it isn't rocket science. Risk and money management. Risk management is really about the soft skills, discipline, patience, common sense. I've written here, don't get too aggressive, don't get too scared to not place trades. Money management will accept when it comes down to drawdowns that occur, and that one fits your personality. So know what to expect from your trading plan and what suits you. But the fundamentals of Ram, I can't see what you're saying next. So can you provide this? You want this PowerPoint in the comment section? Is it my? I'll see what we can do, Ram. Certainly, my friend. Yeah. Yeah. So again, I haven't talked about a trading plan at all today, but I've touched on a few things, skimmed through a few things, but we'll talk more next week about trading psychology. We'll touch a bit more on risk and reward, and more perhaps in the later sessions on trading routine and trading plans as well. That's the last one we're talking about. Okay, so I hope that was useful. Just in summary, obviously risk and money management is a key thing, and as I say, I would argue it's still probably the most important thing. But successful traders merge all this sort of information together: the fundamentals, the sentiment of the market, the mood of the market, the technicals as well. I'm very much a technical trader, but timing, getting in, when to trade, what time frame to trade. But sitting on top of it all is understanding yourself and risk and money management, the simple numbers of the game. What's the leverage on your account? What's the what's the spread on the thing I'm trading? Why has it got so wide? What's going on? What's the liquidity like in the market? Understand those simple numbers. Okay. So thank you for your time today. Time's almost up. Ram, I'll see what I can do with regard to this presentation. But say come to our company at theproptrade.com. and we'll do these webinars on a regular basis as well. Just to wrap up, my 3 favorite trading books of all time remain The Reminiscences of a Stock Operator, Trading in the Zone by Mark Douglas, and any of the Market Wizard books. This is the original one from Jack Schwager back in the late 90s as well. My favorite 2 or 3 favorite books in the last couple of years has been The Best Loser Wins by Tom Hougaard. Fantastic sentiment, and a real trader. Used to be a head technical analyst like me, but real live trader, and it just articulated everything I've been thought about markets over the years as well. Great guy as well. And Tom Hougaard, Best Loser Wins. And the ever erudite and intelligent Steve Goldstein. He runs the Alpha Mind broadcast, Mastering the Mental Game of Trading. Steve was a trader in the city 30 odd years ago as well. He's a great teacher and psychologist, and yeah, it really is a mind game, this trading, and the books are stood behind me here. And as I said, the Trading Game available again from 1999. The numbers to create your own money management system. You're going to take that approach that Ryan Jones explained, and the other, not to be confused with another great trading book by Gary Stevenson that's just come out last year as well, about the rise of a very ordinary poor guy from Essex that became Citibank's allegedly best trader, global trader for many years, and then walked away from it all. Big passionate supporter of ordinary people, particularly here in the UK, and a big passionate campaigner for changing the tax regime here in the UK as well. So there we go. Risk and money management. You've got to have it. You've got to apply it. I hope that was useful, everybody. We are theproptrade.com. Come and check us out if you don't know who we are. And we're here to help, guys. We are the grown-ups in the room, and we're here for you to be successful. So take care, and thanks for your time. I'll see you all next week this time, if not on Monday, when we're looking at the services PMIs out of the US. Join us for that as well. Take care, everyone. All the best.